Let's continue on with this huge trend that we're tracking at Macro Ops. Big trend, big opportunity that's going to play out over the next decade, and there's a lot of stocks that you can buy to profit big off of it. And this is the same trend we've been talking about in our previous 3 stocks videos, which if you haven't seen, you should right now to catch up with what we're talking about. There's a link to this playlist in this video and down below in the description and comments. You can ignore the titles, they're all put in order for you, and it's all about the same trend that we're going to continue to talk about today. There's a lot to cover, so we're doing multiple videos. It's a series. Definitely check out those videos to catch up. And as always, remember, picking a stock is only a small part of the entire process of successful investing. There's more to it. You got to know when to buy, when to sell, how much to invest, when to take profits, how to square what's going on in the stock with the overall market, all those things. It's more complicated. So if you want to see the step-by-step guide of how we do it, then check out this free training. There's a link in this video and down below in the description and comments. I go over the exact strategy that myself and all our Fallible members use, and we're all very happy with it. It's very easy and very effective, and it's really what you need to be successful. You've got to have the full strategy, not just a stock pick. So check that out if you haven't already. So let's get into this research, and you know this comes from Macro Ops, our global macro research and consulting firm. So let's start with a quote from Gavin Baker, one of the smartest tech investors in the game. And what we're going to go over here is the analysis process that we're using to jump on this huge trend that I'm talking about. He said, "I don't believe in edge," and he's talking about edge in the market. And edge in the market is just like, what are you doing to create more returns than the next guy or more returns than the market? He thinks edge is a fairy tale. The world is too competitive. Going back to AI, investing is where chess was in 1996, when there was an enormous race between human grandmasters and algorithms. And Deep Blue started to beat Gary Kasparov by using brute compute force. And basically what he's saying is that investing is changing in a way. You know, the markets never change overall because it's still humans and their emotions. But what has worked before, depending on your strategy, may not work now. So he's talking about the increasing efficiency of the market and how that affects one's ability to generate alpha. And alpha are returns above what the normal market gives you. So if the market's making 8% a year and you're making 10, then that's 2% in alpha in its simplest terms. So in talking about edge, he says that's why value strategies have stopped working. Value investors used to have an edge because they were very quantitative. And maybe they had a strong stomach and they were willing to buy companies because they were cheap, no matter how bad they sounded. But the problem is that anything that can be put into a spreadsheet will no longer generate alpha because it's been arbitraged away by quant investors. Quant investors like us. And you would see what I'm talking about when you take that training. Good to be a quant. There is so much quantitative money chasing the same metrics. To me, all alpha comes from insights, and an insight is a kind of differentiated long-term viewpoint about a stock. It's a differentiated view about the long-term state of the world. And this is the key right here. If you're a discretionary investor trying to make big bets on the future, you need a differentiated long-term viewpoint. So what exactly does that mean? Well, nowadays, like he said, anything that can be quantified will be arbitraged away because we live in a very complex world now where we have alternative data. Satellites are providing real-time updates on retail parking lot traffic, and they detect when manufacturers are adding or reducing shifts. Drones shoot infrared signals at oil storage tanks to gauge inventory levels. Credit card and point of sale system data tracks consumer spending in the here and now and is available for anybody with the money to pay for it. There is crazy data nowadays. Way more data than the rest of us have access to when these people are using drones to track oil storage tankers. So with all this data, the market has become hyper efficient at correctly pricing in the near future. Near future, you could say 0 to 12 months out. Because in the near future, those changes to prices happen in nanoseconds as billions of new data points keep coming through the hoses. The hoses of data. The data hose. But anyway, yeah, there's so much data that it's funny when you hear someone pitch a bull case for a company because of their low relative price to book and a belief that next quarter's consensus estimates are a bit low, yada, yada, yada. All this weak analysis, because those people are playing the wrong game. They're up against Deep Blue, AI, but they still think they're playing against the guy across the street, Bud Fox. But that doesn't mean the game is over for us simple-minded skin bags, aka humans. We just gotta do things differently now. You gotta look into the future beyond where that quantitative data is. You gotta go where it doesn't exist. You gotta operate in a space where things gotta be gamed out and probabilistically weighted. And this isn't a new idea, it's just probably more true than it ever was before. Hedge fund manager Michael Steinhardt played this game over 30 years ago, and he talks about the same thing. He called it a variant perception, which he defined as a well-founded view that was meaningfully different from market consensus. So you gotta see something different than the market is seeing. I often said that the only analytical tool that mattered was an intellectually advantaged disparate view. So that's a bunch of big words for just a smart view that is different from the general market. This included knowing more and perceiving the situation better than others did. It was also critical to have a keen understanding of what the market's expectations truly were. Thus, the process by which a disparate perception, when correct, correct became consensus would almost inevitably lead to meaningful profit. Understanding market expectation was at least as important as, and often different from, fundamental knowledge. So he's kind of saying the same thing I pretty much say in every video. And you can see I didn't come up with it. But the whole idea about markets is gauging these expectations. Because markets, again, they aren't just based off these fundamentals in a vacuum. What really matters is how investors react to those fundamentals. And their reaction is based off their expectation. So that's what he's saying to gauge here. You can't just look at fundamentals. You got to look at what the market thinks about those fundamentals. And then if you have a different view that you think makes a lot of sense, that's where the potential is for a ton of money. That's that variant perception. So he gives an example here. A summer intern reminded me years later the advice I had given him on his first day at work. I told him that ideally he should be able to tell me in 2 minutes 4 things. 1, the idea. 2, the consensus view, which is the market view. 3, his variant perception. And 4, a trigger event. And that's no easy feat. So again, what is the market thinking? What are you thinking that's different? And then what would cause that difference to occur? That's the trigger event. In those instances where there was no variant perception, that is solid growth recommendations within consensus, so the market thinks one thing and you agree with it, that means no variant perception, then I generally had no interest and would discourage investing. So in those cases, he wouldn't see the alpha and wouldn't think it was worth it. Another example is the recent interview in Patrick O'Shaughnessy's podcast with Modest Proposal. And these are big FinTwit people. So he talks about underwriting the past and underwriting the future. So underwriting the past meant quantitatively looking at historical performance and trying to focus on business fundamentals irrespective of view on the future. Investors who underwrite the past want as much certainty as possible. So basically they're extrapolating what happened in the past into the future. And they do that based off their fundamental analysis. Or it could be technical too. I mean, the point is that it's rear view analysis. But underwriting the future is more qualitatively focused and requires an investor to be comfortable with uncertainty as they build a view on the future of a company through strategic analysis. You know, the way some of these guys speak and write, it's just too much. Too many words. And I could barely pronounce anything as it is. But anyway, the best performing investors over the past 20 years belong to this group. These are the people that are underwriting the future, looking ahead, working within that uncertainty, having that variant perception. This variant perception is the critical factor in assessing the expected value of a long-term discretionary bet. If you're trying to bet big for the long term, you need to be doing this. Forget about what the next quarter's earnings will look like or where the margins will be later this year. That game is over. The robots won it. It's time to move on. So if we were to put this into a graphic, this is what it looks like. The first 0 to 12 months out, the market is able to price very efficiently. We call it the efficient market box. But past that point is where you hit this veil of the future, where the quantitative data does not work anymore. So what most investors are doing is that they're looking back on the previous data, extrapolating 0 to 12 months out, and then using that same growth rate to say, hey, that's what's going to happen for the next however many years. That's that trend growth extrapolation right here. See, it's a narrow cone of extrapolation because the market tends to price the future much like the past. But if you have that variant perception, then you could imagine things going like this. This is the non-consensus outcome. This is what everyone in the market thinks. This is what you think. So the difference between these two, well, that's a huge opportunity because it's a mispricing of the future. And again, this happens in the more distant future because the robots got all this marked down well. So this is what you need to think about when you're making long-term bets in underwriting the future. So there's a few reasons why things can be so mispriced, why there's such a divergence, this green line from this red cone. So one reason is because the market is slow to recognize competitive advantages as well as underappreciating its impact on future value creation. So the market isn't perfectly smart. They underestimate things and those things impact on the future. Market also tends to underweight the impact of secular macro shifts while overweighting cyclical ones. Once again, saying the market is focused on the short term instead of the long term because the long term is just endlessly more complicated. The market is also inefficient at pricing anything exponential. So this type of curve that goes up like this, market can't price it. Same thing with options models. Like if you look at the Black-Scholes model, long dated options are not priced properly, at least if you think you have an edge, because the market can't price out that far in the future. So the stock and the trend that we're talking about benefits from all of this. That's why we're talking about it. That's why we got so many videos about it. Well, we're gonna have 3 now and a 4th one is coming too. And that's the huge AI trend. And the company I want to focus on specifically in this video is Micron. They are a global supplier of DRAM and NAND semiconductors. And if you watch the previous videos, you will hear me mispronounce this terribly. You might throw up eventually, but you know, it's okay. I'm doing it right now. DRAM. Now, most people look at a company like Micron and they don't think it has a competitive advantage. And that's because the space, the whole semiconductor space, and by the way, the whole idea here, if you haven't watched these videos, is that the whole semiconductor production is going to explode because of AI and the demands that AI needs, and we'll talk about that more in a second. But previously, before AI, this has been a really cyclical industry with weak margins. But this is changing due to consolidation and the slowing of Moore's Law. So take the DRAM market, for example, which is approximately 75% of Micron's revenues. So making that DRAM used to be a poor business because there's a ton of competition. There was a ton of competitors fueled by cheap government money. So there was an extreme capital cycle of oversupply that led to big busts. They created too much, or they produced too much, and then the prices would collapse, and they'd have too much stock, they couldn't sell it, their margins would get crushed, it sucked. But that competitive landscape has dramatically changed. Since 2010, the industry has consolidated from 8 large DRAM makers to only 3 today. You can see that right here. The industry has been cleared out. And now the DRAM oligopoly consists of just Micron, Samsung, and SK Hynix. Similar consolidation has occurred in the NAND space as well. And this consolidation was necessary because of what's happening with Moore's Law. And Moore's Law is the doubling of transistors on a microchip every 2 years. It's like a technology growth rate thing that you probably heard about before. But it's become prohibitively expensive to maintain this law because it's like exponential growth. And actually, the whole thing may be slowing altogether. So to deal with Moore's Law, suppliers were forced to scale to remain competitive. And that has actually improved the industry's fundamentals. The oligopoly that has formed because so many went out of business has brought more prudent supply growth along with rising and stable margins, which we never had before in this industry. So you could clearly see this in the data. Micron was actually able to stay profitable during this CCPV pandemic. During it, they generated a positive $2.83 in earnings per share. That's a first in the company's history. Micron now sees 45% gross margins. And that's a huge improvement from the past where at the peak we saw low to mid 30s of margins. And a big thing fueling this is the secular macro tailwinds, which we know the market does not price in properly. And again, we cover this more in detail in these videos, but it's the whole idea of AI really boosting this industry. Semiconductors are in the same place where the oil industry was in the early 2000s. And back then, China's massive leveraging cycle was just getting started, and this created a super cycle for oil companies. But this time with semiconductors, instead of China, we have the rise of artificial intelligence. And we have all these huge data centers, the Internet of Things, AR, VR, autonomous vehicles, everything is becoming computer. And as a result, data and compute power are the new black gold. So Moore's Law scaling challenges have shifted more of the burden and value to software. But AI changes this paradigm because compute matters again, and there are little to no scaling limitations to the problem set. For AI, the more data you have, the better the outcome. So we need a lot of hardware to store that data. And that creates a new virtuous demand cycle, much like the combustion engine did for oil. So the whole demand paradigm has changed. Need way more chips than before. AI servers will require 6 times the amount of DRAM and twice the amount of SSDs compared to standard servers. 90% of the data available in the world today was generated in just the last 2 years. And it's expected to grow to 180 zettabytes, or zettabytes? That's 21 zeros. That's insane, by 2025. To put a zettabyte into context, storing just one requires 1,000 data centers, or about 20% of the land area of Manhattan. Where is all this stuff gonna go? We gonna put them all in the ocean? What is this? Market forecasters estimate that the AI-enabled market can grow from $6 billion in 2017 to approximately $36 billion by 2025. And according to the Intel CEO, a single autonomous vehicle will generate and consume 40 terabytes of data for every 8 hours of driving. Wow. And 1 million autonomous cars will generate as much data as 3 billion people. So insane amounts of data here. According to Gartner, driverless cars contain over 80 gigabytes of DRAM versus 5.5 gigabytes in PCs and 2.5 in headsets. So just some more data to show you how big the opportunity is. And the thing is that AI works by brute force. So the more data it has to train on, the better it becomes. So you want tons and tons of data. So the need for that computing power is only going to accelerate from here, exponentially so. And the fact that there's only a few companies in the world, there's an oligopoly right now, with the engineering ability to create the foundational tech that's essential to this growth. And one of them, Micron, trades at just 7 times normalized earnings, is crazy. The market is really mispricing this. If you look right here at the monthly chart of Micron, it is coiling tightly over the last 2 years. And when something coils this tightly, it usually leads to a very big expansion. And that's what we're likely going to see very soon here. Now, the sentiment and the general narrative around this stock are to be as expected. People are thinking about the short-term cycle. They're not looking at the long-term. They're worried about narrowing margins over the next quarter or two and the company's exposure to China. Those are all short-term things. What they fail to see is that Micron is only one of 3 companies in the world. So it's like 1/3 of the market that's able to produce a component that's increasingly critical to the AI stack. And it's the only one based in the US too. So what's happening here is the market isn't looking past that veil of the future because it can't. It's not seeing that AI and the Internet of Things is going to become an integrated part of every part of our lives. And that secular shift shift is going to support a steady exponential demand growth, and that means significantly higher stock prices. So again, looking back at this graph, AI and a company like Micron, we're seeing something like this green line. The rest of the market is pricing in this type of expansion, this red cone. See the difference here? That's where you can make all the money. This is where the alpha is. This is where you got to think differently than the market. And we have more coming about this topic. So if you want to see that, make sure you subscribe. And don't forget to take this training either, because if you want details about how to play trends like this, well, they're all going to be right here. So you can learn how to do it yourself. We make it very easy and very effective. So check this out. There's a link in this video and down below in the description and comments. And again, make sure you subscribe for the next video, and don't forget, stay fallible out there. Bye.